my mindset when I go into these kind of companies is not, oh, I'm going to hold them for 20 years, because
everyone dreams of finding the next 100 bagger, but almost nobody actually does it.
You can only look for certain traits in companies that might give you the possibility.
Today I'm joined by Kevin Schoovaerts, the mind behind 100 bagger hunting, who has spent years studying what makes tiny, overlooked companies turn into life-changing investments.
The goal should always be to strengthen your portfolio. It should always become better and better and better.
In this conversation, we'll explore not just the big winners, but also false starts, the systems and the discipline it takes to stay on the course when the world is screaming the opposite.
Picking the bad company, that was not a mistake. The biggest mistake I made was...
Guys, let me tell you a 30-second story, and I promise you won't regret it. So when I started to take investing seriously, I really didn't have anyone to discuss my ideas with. I knew no one in the investing space, and therefore my process felt kind of lonely and very slow as well. So I went on and found a community of serious microcap investors, people that actually like doing the work. And I'll let you in on a little secret. It's called microcapclub.com. Members have profiled more than 1,300 companies, and over 300 of those have gone on to become multi-baggers. That's the power of this group. The awesome thing is that you'll get exposed to ideas well before institutions ever notice them. And if you want to find great businesses and surround yourself with some of the best investors in the world, head to microcapclub.com and consider applying to join or becoming a subscriber. That's microcapclub.com. Nothing in this conversation is financial advice. I may hold positions in some of the companies we discuss or have other interests. I always aim to stay objective, but please take everything with a grain of salt and do your own research. How do you find stocks that return 100 to 1? I know this isn't an easy one, but yeah.
The most common question I get from a reader is they send me an email and they give me a ticker, and then they ask me, is this going to be a 100 bagger? Yeah, but that's not how it works. I don't know if you saw, but David Garner from the Motley Fool, he just released his book, Rule Breaker Investing. I think he nailed, I don't know, 700 baggers or something in his 30 years. And even he says in his book, you can't know in advance. You can only look for certain traits in companies that might give you the possibility. And on my newsletter, my slogan is, I look for small quality stocks that double several times. And that's the basic idea. I try to find a quality company, usually in the smaller space, that I think has a good probability of doubling. And if you do the math, if you can do this 7 times in a row, then you get a 100 bagger. So that's basically the idea.
Nice. And what sort of beliefs or just preconceptions you had before that you had to deconstruct to kind of make this process even feasible?
Well, my background is a bit my background is I'm a nuclear engineer.
Wow.
And when you come from a nuclear engineering environment, I had one advantage is when you work at the power plants or in nuclear engineering, your DNA is ingrained into risk management and probabilities.
Mm-hmm.
And that, I think, is a big advantage in the stock market because, the stock market is more like a poker game, less like a chess game. So you need to think in bets, you need to think in probabilities, and also look at the downside risk. And that's something I think I had an advantage in when I started investing. But I had one big disadvantage because I came from nuclear engineering. I was used to calculate everything precisely. And that's not how it works in the stock market, especially when it comes to valuation. Valuation is by definition unprecise. And I think I had to struggle the first years to overcome that and to get more to be directionally right instead of trying to be precise. So yeah.
Got it. Yeah, that's such an interesting background. I think I never interviewed a nuclear engineer, and I just want to congratulate you for going through that route because
I did do 1 year of mechanical engineering, and yeah, I can tell it is very challenging. And yeah, so I just want to kind of go down that rabbit trail. What sort of lessons did you learn as a nuclear engineer? Obviously, you mentioned probabilities and dealing with risk, but is there any sort of interesting story you can tell us about your nuclear engineering career?
Yeah, I think one of the biggest things from my career that I can take back to stock investing is that hunger for continuous improvement. So when you work in the nuclear industry, in your DNA is ingrained that always getting better. So 1% better each day, because we want to make everything safer each day. I want to make it more efficient. And it's the same thing when you learn about investing. It's a never-ending journey, and you just. I think the goal is to, if you focus on just getting better in the investing game each day, even if in the short term and the first years your returns are not that great, they will follow eventually. Because wisdom and intelligence, or not intelligence, but wisdom and experience in the stock market compounds over time, and I think it compounds faster, sadly, than the portfolio returns. So yeah.
Got it. That's very interesting. And have you ever sort of looked at I don't know if there are any listed companies that deal in nuclear power or something, but is there anything interesting to look at there? Um,
Yeah, I recently posted about Oklo,
okay.
but yeah, not maybe in the positive way, because you've got a $20 billion market cap company with no revenue, with a lot of promise. And I looked at the technical side of it, like the nuclear reactor design, etc. There's no innovation in it. The only innovation within the company is the business model, because
Mm,
they have these predetermined purchase agreements to take off power from them. So there is some sort of pre-financing, because the biggest problem in nuclear is the capex. You need to
yep.
put billions before you can construct, and so the return on investment is way out into the future. So they're trying to, yeah, change this with Oklo, with the business model. But yeah, I mean, a $20 billion company, no revenue, and insiders have been selling over the last weeks. So I don't think it's a great idea. But I don't specialize in nuclear or in the nuclear industry from my investing point of view. Yeah.
Okay, got it. I had sort of this crazy question for you. So I was thinking, what if there was like 100 bagger ETF, right? I'm not sure how well it would work, but if you really had to build one, someone puts a gun on your head and said you have to build 100 bagger ETF. What criteria would you use, and what sort of weighting would you apply to that?
That's a very hard question. Let me think. Um, well, I think if you had to build, so this means you have to build an ETF that holds or tracks companies that are likely to become a 100 bagger in the future. Yeah, it goes a bit against what I said at the start, that it's very difficult to see that. But I guess what you would have to do is try to find companies where you are more focused on the quality, and the quality in the sense of who is the CEO, what is the management doing, what is the culture of the company, um, as opposed to like pure valuation or pure financials. Because
Mm,
what you want is like increased optionality and innovation. And so this means you pick companies that have a very broad uh, panel of outcomes.
hmm.
So very lots of different futures. But I think it's hard. I don't think somebody will build a 100 bagger ETF soon. But yeah, you need to then focus on more on the maybe the non tangible part and the quality part, and not on the numbers.
Yeah, but how would you assess that? Because essentially, like an ETF, it's supposed to be a like yeah, low maintenance kind of thing, right? So probably you'd be very diversified and had to pick one or two criteria, because otherwise it would be really hard to, yeah, the fees would be way too high, because someone would have to spend literally like hours and hours studying each company just to add it to the ETF. So I'm thinking, for example, like S&P 500, so 500 companies, like what criteria would you use to broadly like screen for or increase the probabilities of at least like a decent percentage of them becoming like multi-baggers, and maybe like one of them becoming a 100-bagger?
Well, the probably the easiest criteria is to be more sector specific, because based
Mm,
on the past data. So if you look at the book Beggars by Christopher Mayer,
yeah,
or past studies that have been done. For example, in April, there was a study released by a university in the UK that studied like 500 multi-baggers over the last 30 years. And they did found certain sectors that are more heavy in multi-baggers. So that means something like software. Basically, it's a sector where you have higher margins and lower capex spend to get to a certain growth rate. Um, and so, yeah, that would be my first criteria: is limit the number of sectors, don't add utilities, etc. But focus on, for example, industrials, software, IT, etc. And if you look at the S&P 500 now, the biggest winners are those that are in that sector. Yeah.
got it. And now, like switching gears to your personal approach, how do you think about sizing and diversification in general? Because at least from my understanding, if you're fighting to find 100 baggers, you both want to maximize the upside, so you don't want to have like 0.5% positions, because otherwise, like even if it's 100 bagger, like you would miss on a lot of upside. But at the same time, you want to kind of spread your bets, because yeah, it's very unlikely that you'll have a three name portfolio and the three of them will be 100 baggers. So
Yeah, sure.
yeah, just let me know.
Yeah, maybe first to give some context. So
Yeah.
if people go to my website, they see a logo, and it's the typical yin yang logo, and that's because my investing strategy is split into two parts. And you have like the light side, that's like finding these great quality companies that can keep compounding far away into the future. Usually, the biggest problem with these companies is they have a premium price tag. Um, but I try to look for those. An example of those is, for example, Adyen. It's a payment processor, a high quality company. Um, and it was on my list for a long time, and I only bought it when it dropped. I think it was in 2023 when it dropped 40%. Then I got in, but I'm a bit too price sensitive to buy these bigger companies. But then these companies, you typically hold them like, the idea is that you hold them like minimum 5 years or 10 years or more, because you need the compounding and you need the time to get that return, because you're overpaying in the short term. So you need time to get the return back. Um, but the problem with that is you can't really touch those. You can't really do something. So somebody who has like, let's say you have a 15 stock portfolio with these kind of companies, the idea is that you just let them compound. It's like watching paint dry. It's pretty. You don't have a lot to do. You follow the companies, but you can't really trade in the market. And I like to be. I like to take action. So that's the second part of my strategy. It's the dark part.
Mm,
Um, and there we go more into the smaller companies, into the micro caps, where
yeah.
you're more focused on finding something that can double in 3, 4, or 5 years. And my mindset when I go into these kind of companies is not, oh, I'm going to hold them for 20 years, because um, I think assigning a moat to a microcap is foolishness. You will have big problems if you take the same approach that you take in a high quality company and go to a really small quality company.
Mm-hmm.
And I think the fact that I combine both strategies, they enhance each other because it's a bit like opposites. But yeah, I learn from both. And I think if I would have just stayed with one strategy, I would have been yeah, I would have learned a lot less. Now, to get back to the position sizing,
Mm-hmm.
basically, I always build positions, so I never go all in like 15% in a single stock right away. I prefer averaging up. I have very bad experiences with averaging down, especially when doubling down on a stock. So that I never do, or I hardly ever do. And then I will start with an initial position or 1 or 2% just to get to know the stock. And then over a couple of quarters, when I get to know the company a lot better, I will build the position up. Usually, my core position size is between 5 and 7%, but sometimes I do oversize to a maximum of 15%. And but that means 15% means I really think I have an edge. It's like in poker, you bet, you raise the stakes when you have an edge. But if you don't feel like you have an edge, then there are two possibilities: you don't play at all, or
Mm-hmm.
you only place very small bets. Um, and what really impacts position sizing for me is the downside risk. So if I feel that this is like a very speculative bet and I could lose 100% in the next year, but I still think there might be some kind of big upside because of some optionality, but maybe I will only size it at 2-3%. Um, but yeah, it depends on the type of company and on the downside risk, because I own like all sort of stuff. If you look at the life cycle of companies, I own startups. I have young growth companies. I have mature growth companies, and I have companies that's in decline. So it's like the Peter Lynch approach, where you take all the stocks and you put them in buckets, and then
Mm.
you approach each bucket in a different way. But of course, I prefer fast growth, high growth.
Nice. That's really interesting, that barbell approach, because it's very similar to my approach. So I naturally like it. um, where you basically have higher quality companies that maybe you're paying a slight premium for it, and then you have those sort of smaller companies, and maybe you're aware that the business models aren't like extremely durable, but you can see like an inflection or like something clear in the near future that will, yeah, make the business double or something. So that's very interesting. And I'm also curious to know, like, obviously the theory of 100 baggers is that you have to hold these businesses for a long time, but in my short personal experience, there are very few businesses that deserve being held for a long time, even those that initially you thought were extremely high quality. So, in practice, what sort of turnover do you have, and how does it look like in your portfolio versus what your goal, I guess?
Yeah, yeah. Um, yeah, because it's like 50-50. Like the companies or the high qualities companies I own them for many years now. Um, so the turnover on that side is very low. But when it comes to like micro caps and very small cap companies, yeah, I think it's like 3 years on average. 3 or 4 years that I hold them, not longer. Sometimes I even go faster, because what you see in microcaps sometimes is that the company can be undiscovered, and you find a quality company, and for some reason in the coming year or 2 year, the story gets out, and then you see a massive price increase, It can be 100%, 200%, 300%. And what usually happens is that the market gets a little ahead of itself. The price increases so much that the price in the market goes beyond what I think is the intrinsic value of the company. And then usually what I do is I will start trimming. I will never outright sell unless there is a clear break in the thesis, in the initial thesis. I prefer adding and trimming.
Mm-hmm.
I think maybe one of the biggest lessons I learned from my investing experience is, in the beginning I was mistakenly thinking that it was a discrete process. So you buy and you sell. You buy low and you sell high. But over time, it has become more like a continuous process. It's You take an initial position, you add, you add, you add. If it's overvalued, you trim a little. If the thesis breaks, you keep trimming and you sell. So it's more, a continuous process over time.
Man, I want so much to double click on that because I think I'm at that phase where I understood finally that it's not like, as you said, like binary, or like you have to pick one or the other. You can just go slowly towards one of the spectrums or like one of the extremes. And because, for example, sometimes I've let's say built a position too fast, or like bought the whole position right away, and maybe if I had waited some more time, or uh, built it slowly, I could have got a lower kind of average price or cost basis. And other times where I sold everything right away, and then the stock went up a lot, and so I was better off like waiting a few quarters and maybe seeing how the story develops ahead. So I want to ask you a very specific and technical question, which I know is hard to generalize, but yeah, I would love if you could give it a shot. Which is, how do you size those like let's say trimmings, or like adding a bit, or subtracting a bit to the position? Because for me, I'm also kind of a, I don't know, like engineering mind, so I like to have a very clear process and less artistical and less subjective. So how do you think about sizing those actions?
Yeah, it's a good question. I don't know if I have like a clear cut process for this. Uh,
Mm-hmm.
I usually, I mean, when I talked before about doubling down. So, for example, if you have a position and you double the position but the stock is going down because you're so convinced the intrinsic value is there. I do not longer do this because this has cost me a lot of money, because um, most of the time the market is right. And so each time you're doubling down, you're betting against the market. So you need to be really, really sure about what you're doing. What I do now, when I trim, if you first look at the trimming, is I will probably do it with quarters, and it depends on how the price has evolved. Um, I can give you one specific example.
Yeah, that would help.
There's a company I bought a year ago, FormX Technologies. It's like a very small Australian company, which I think still has a lot of potential. By the way, I found this company through Jakob Kreutzmann. So yeah, he's a great investor. And when I did my own due diligence, so I stepped in, and over the last 18 months, or maybe it was less than a year, it has tripled. Um, because the market is recognizing what the new story of the company is. It's not based on hard fundamentals. The company has grown, but as I said, the price seems to be getting ahead of the value of the company. So I decided to trim. I took off a quarter. Now, how did I came to a quarter? There is no defined rule, but I think it has to be. You need to adapt the trimming to the conviction you still have in the company. If imagine that the company you don't longer have as much conviction, and the price has gone up. Then maybe you would trim half. But if you still believe in the company and you still see its future, and the only reason you're trimming is because the price has gone up a little bit too fast, and you think the market is a bit overheating, then don't trim too much. But yeah, I know it's not an engineering answer, but I don't. I think it's difficult.
Yeah, as long as it's the real answer, that's what matters. And yeah, I definitely want to experiment and um, just see how it goes for me. Yeah, because of the reasons I stated before. So we've talked enough about like systems and engineering and those sort of things. What sort of other systems help you stick to your process, or that you feel are unique to your process, or maybe not a lot of people do it?
Well, I'm very process driven. So I have a funnel. So for example, it is in several steps. So when I look at a company, I will take 15 minutes and try to dismiss the company right away. And then if I don't dismiss it, I will put 1 or 2 hours in it and try to do the same thing. And then after that, if it's still a viable investment or company I would like to analyze, then I go deeper. The basic idea, of course, is to not spend too much time on a company right away because we are all limited in the time we have. Um, and yeah, and since a year now, I've been using AI for this because it greatly speeds up the number of rocks I can turn. And also it greatly speeds up the number of companies I understand. Because sometimes in certain industries or companies, when I read, like, for example, the investor presentation, it's not very clear to me how they make money, how the selling process works. And this, for me, something like GPT-5 is very strong at. It can break down the business model in a very simple way, and it can, yeah, and it can like write you down step by step how the sales process works, and that's very important, I think.
Mm-hmm.
And then once I go deep, then I have it's like an acronym I use. It's a 7-step approach, and it's called "How Special Is a Company?" And the special stands for everything you can think about when you analyze a company. So the S is sales strength, the P is profitability, the E is endurance. Basically, it's the balance sheet and the resilience. The C is competitiveness. The I stands for industry. The A stands for asset agility, and the L stands for leadership. And so with special, I cover everything. Um, and that's how I go. I write my deep dives, and I go into a company. Um, Once I go through all of that, I assign a score, like a quality score, but it is completely separate from valuation. Only at the end will I value the company, and the valuation method will depend on the type of company, where it sits in the life cycle. Yeah, it depends.
Yeah, I think it's very interesting also to own like a lot of different kind of investment cases, because you learn to value pretty much, I wouldn't say everything, but much more than if you would just focus on software or just focus on mining or whatever. So that's very interesting. One thing I wanted to ask you, because you mentioned you only do the valuation after you take care of the quality side of things. How do you make sure you're not like spending too much time on companies that are extremely overvalued? Obviously, you can see that from like if it's trading at 60 times sales or 50 times sales. I don't think you'll spend time on it, but um, sometimes like you actually dig into the financials, and maybe uh, actually the net income is overstated, or whatever you use as a proxy of cash flow is overstated. So yeah, how do you take care of that side of things?
Well, I think it's like I just said before. It's not like a very distinct process. So when you go through the company, you already have an idea about the valuation, but I try to not put it in writing up until
Hmm.
the end. But of course,
Okay.
when you look at an opportunity, um, you probably already have a rough idea about if it's interesting or not based on value. Because if
Yeah.
you're right, if you only look at the company and you don't think about value, yeah, it's like you say, you're going to waste a lot of time. It's just that what I meant before was that I'm not writing it down in a
Mm,
very clear way before I've analyzed the entire company.
got it.
Yeah.
That makes sense. And I want to talk now a bit more about my issues with 100 baggers. And
Okay.
maybe you can help me change my mind. So,
Now it gets
uh,
interesting.
yeah, let's go for it. And I must say, just to give you some context, I started out as a very big fan of the concept, and because obviously it makes total sense. Like, you really invest with the high quality companies with high quality leadership, and sit on your ass and like wait. Um, so my problem with 100 baggers is that most of the times, as you mentioned, like hindsight plays a big role, and maybe the author you mentioned from the Motley Fool, David Gardner. I'm not sure if that's the correct name, but he said like you can only spot 100 baggers in hindsight, and you may have a criteria that increases the probability of finding them, but yeah, my issue is that I think it's almost impossible to to analyze. Like if you get 100 bagger, most likely there was a lot of luck involved, and even if you actually analyze correctly and you say okay, this is 100 bagger, and it actually becomes 100 bagger, there's the other side of the coin, which is even harder, which is holding through the 100 bagger period, right? So I think the only person I know personally that has held on to a 100 bagger, or at least two of them, is Jason Hirschman with XFL and Mike Diddy King. I don't know the name of the company, but it was a 100 bagger as well. So, and I know a lot of investors, and that's a very small portion of
Mhm.
the people I know. So yeah, how do you reconcile all of this? And isn't there a risk that actually you'll you'll hurt your returns by being so long term, and maybe you should be a bit quicker on the trigger, like either selling or buying?
Yeah. So maybe I'll explain first why I chose 100 Bagger Hunting as the name for my publication.
Mm-hmm.
And you're completely right. I mean, there's a significant survivorship bias, and the
Yeah.
probability of nailing a 100 Bagger is very small. But I see it differently. I see it from a mindset point of view.
Mm,
Because when I started investing, one of the biggest mistakes I made, for example, when I bought a company, is the company went up 40%. And then I said, oh, let's take profit. And then I sold. And I was happy with my
yeah.
40%. And then I went to the next one. And after the first years, my return was below the market.
Mm,
And the problem is not, the problem there is a mindset problem. You have to aim higher. So you have to aim, like I said before in valuation, when I see people write articles and analyze companies and they say, hey, I think this is an interesting opportunity because I think the price should be 23% higher than it is now in the market. Then, yeah, I mean, for me, that's complete nonsense. You need to think in doubles, in triples, in quadruples, and ideally in 100 baggers, but it's basically changing the mindset. Now, the second part of that is I do think lots of people don't hold on to their stocks long enough. That doesn't mean you have to hold on to the stock for 25 years, but it does mean you should be able to try, if the stock still keeps performing, to hold it on for longer than a year. If all the data is correct, the average holding period is 6 months. That's, I think, a bit too short. So that's the second thing. Now, when it comes to actually nailing a 100 bagger, you're completely right. The probability is very small. Um, so I'm doing my own data analysis to try to build, and I say this with a lot of humility, trying to build on top of what Christopher Meyer wrote in his 100 bagger book or other studies in the past. what is very clear from all these studies is there is significant survivorship bias. So what most of them do is they take, for example, over the last 30 years, the 100 baggers, and then they try to distill from that certain criteria and certain traits. And then they say, well, you just have to look for these traits, and then you can increase the probability of finding the next 100 bagger. Now, this isn't necessarily wrong. The problem is maybe there were companies out there that didn't make it, but that also had the same traits. You're not taking into account survivorship bias, and that's something I want to rectify with my own study. But yeah, you're right that for me it's more like a mindset, and that's also what I said at the beginning. We try to look for companies that can double, and if they can do it 7 times, then it's a 100 bagger. That should be the mindset you're looking for.
Yeah, I totally agree with that. I think it's always about the way you frame things, right? And I was framing it more from a, yeah, like a practical standpoint, not a mindset one. But if I reflect back, I also have that mindset. So maybe before I was looking, okay, let's do like 15% per annum, and if this is a double, like in, I don't know, 5 years or something like that, then it's good enough for me. But I think you want to aim way higher, like extremely high. And one of my key questions right now is, is there a scenario where this can double in 12 months? It doesn't have to double in 12
Mm.
months. Obviously that's an extremely short time frame to double. But if there's a scenario, then there's a probability. And so you want to expose yourself to as many of those as possible, because you'll end up sometimes actually finding companies that will double in 12 months if you go for that. And so I think that aligns closely with everything you just said. And I encourage people to also take that mindset, because if you can take the kind of the, I don't know, the sadness or uh, insatisfaction of not reaching your goals, but still reaching higher than you previously was aiming for, I think that's all you need to do, right? Because maybe you can set a 30% hurdle rate or 40% or whatever. Maybe you won't get to 40 or 30, but if you get to 20, then that's still very, very, very good. So yeah, I totally agree.
Yeah, I had a similar discussion with the reader in the past because at the start of this year, I started a new portfolio,
Uh-huh.
and I set myself a hurdle rate of 15%, because it's my historical hurdle rate. Um, and for the moment, that portfolio is still 50% in cash because I'm taking my time to build it slowly. And the performance for the year has been great, even though only has 50% cash. But I asked the reader, what should I do once the portfolio is fully invested?
Hmm.
And what I answered, because I answered my own question, is increase the hurdle rate. Because if the goal in the future is the goal should always be to strengthen your portfolio. It should always become better and better and better. And so if I, for example, find 15 companies that I think can pass 15% hurdle rate and my portfolio is fully invested, then the 16th company I should add should be better. And the easiest way to do that is to increase your hurdle rate because you're going to find lesser opportunities. Um, so, for example, if I don't know, I don't think I will be fully invested at the end of this year, but imagine that somewhere in February, March next year, the portfolio is fully invested. I will probably bump the hurdle rate to 25%, and I will start to hunt for companies that can double in 3 years instead of 5 years. Yeah.
Yeah, I'm sorry I was looking sideways, but I was just trying to find the button to create a clip or a timestamp, because I want to go back to this. And I think this is the first time I come across this idea. And maybe you see I'm a bit excited, because I always get excited when I find like something new that actually like makes a lot of sense. And I never thought about it that way. Like okay, I have a full like I have zero cash. Now what's next? Maybe it isn't always like sitting there and just relaxing. Maybe it's actually upgrading the portfolio and see where the weak links are, and that makes total sense. And actually, I don't think I ever said this publicly, but I'm managing my dad's portfolio and it's fully invested. And yeah, I don't know what to do with it because it's fully invested. It's like a longer term, like coffee can approach. Like 10 names are coffee can, and then 5 names are micro caps, which I own for my own
Mhm.
portfolio. And so yeah, I don't know what to do next, rather than just monitoring the companies. And I think that's a great approach. I was targeting kind of a 15% return, as you said. Maybe now I can go for 17 and a half or 20, and yeah, that's extremely useful kind of mental model.
Yeah, the only thing is, I would only apply it to like smaller companies, micro cap companies, etc. Because if you have like a super high quality company in your portfolio, um, which you believe has a lot of optionality, then by
Hmm.
definition, valuation is extremely difficult. And
Yeah.
so there is a danger there where you say, oh, now I'm going to increase my hurdle rate to 25% to swap it out with something more short term, which maybe could be a better short term investment. Um,
Hmm.
but I would be careful with that. Um, Based on my experience, the higher the quality of the business, the less valuation matters. Price entry is always important.
Hmm.
Um, I mean, if you Nick Sleep, who was the portfolio manager of the Nomad Partnership, when he bought Amazon at $10 billion, I think it was in 2004 or 2005. It looked overvalued, um, but there was a lot of optionality hidden inside the company, and so you need to be careful. But if your focus is on small companies, maybe 500 million or below 2 billion, then you can apply this approach all the time and increase your hurdle rates and try. Because if tomorrow, imagine that your current hurdle rate is 25%, and you say, okay, I'm going to increase it to 35%, you you shouldn't find a lot of opportunities, but those
Hmm.
that you find are probably higher probability in return. So
Makes a lot of sense. And whenever someone, I love Nick Sleep. I love the Nomad Partnership. But again, you never know how much survivorship bias there is. Maybe they
but
were
there's a
lucky.
lot.
Maybe they were extremely skilled. Um,
Nick Sleep, he said it himself in his last letters. He said there was a significant amount of luck involved. So if I mean, it could have been somebody else.
mhm.
You just don't know. It's a significant survivorship bias, but you just have to be aware of that. That doesn't mean that you can't like the story and there's no lessons to be learned, but just be
Exactly.
aware of the survivorship bias. Yeah,
Yeah, I think that's great. And I don't know if you can see it back there, but I have Thinking Fast and Slow, and I think when you study the biases, it's not that you're thinking, okay, now I'm a god that thinks rationally and
yeah,
everything I do is rational. It's what you said. It's more about, okay, now I'm mindful of them, and I can at least try to minimize the bad effects from those
sure.
biases.
Yeah, because when you go into biases, one example for is like the endowment effect. So
Yeah.
the fact that you own something, or commitment bias, the fact that you spend hours and hours and hours analyzing a company, and you have to try to put in place in your process certain steps or actions that mitigate these. So, for example, what I do to avoid, because I run a newsletter and I analyze stocks on a regular basis. Sometimes I spend 80 hours on a write up, but usually I will put it away for 2 weeks before going back to it, because after just after completing the write up, uh, and it's a positive write up, um, then I'm more inclined to buy the business. and then I think you have to have a very rational mindset in the market. You have to avoid all biases and emotions. So what I usually do is then wait for 2 or 3 weeks, then go back to the article, and then if it's still interesting, buy the company. Because what happens in those 2 or 3 weeks is I would have analyzed other companies, and maybe you find something that is even more interesting. But if it's still the most interesting thing, then you can go for it. And you like there's like tricks and things you can do for yourself to minimize all those biases.
Yeah, that's extremely interesting. I think most of us would benefit from yeah, just applying that small trick, because one of the lessons I wrote down in my reflection of the first half of the year is that usually, and this doesn't happen always, but I think you want to kind of have a strategy that works most of the time, not all the time, but usually you have more time than you think to enter a position. It's very rare the occasion where you have to act real fast. So yeah, maybe I could benefit from applying that for myself. There, for example, I there was one idea that I wrote up for the microcap club, and this idea I started researching it. I think at $2, or yeah, maybe less, but $2 or so. When I finished writing it up, it was at 3.6 or something.
Okay.
So I think the those kind of experiences kind of really traumatize you, and you think, oh, I missed such a big way. But maybe most of the time you're actually buying too early, or like acting too fast, and you could wait. And if you waited, maybe you'd get a better entry price or something. So
Yeah, sure.
can you share some practical experiences yourself of maybe something related, or what you think in general about what I just said?
Yeah, I mean that happens to me also, but I haven't seen an increase from 2 to 3.6 in just in the time I was analyzing the company, because that's a very extreme increase.
Yeah.
Um, I saw it a little bit with the company I mentioned before, Formex Technologies, because it hasn't stopped increasing over the last 18 months. Um, but yeah, I mean that's I think it's not the norm. You shouldn't come from that, and the learning shouldn't be, oh my god, what am I doing? I'm traumatized. I think it's unusual, and
Yeah.
what I usually also do is maybe at 3.6 it's a better investment than at 2,
I
because
mean, in 1 week, it depends.
it's only in a week. Okay,
Yeah, it was 1 week, literally. And this is a very, very specific case. Like, the company was at negative EV. So, like, they had, just for simplicity, they had more cash in the
okay,
bank than their market cap. And so, like, they were imminently going to turn profitable in the next quarter. Like, basically, management guided for that.
yeah, okay.
And yeah, so there was a very rapid increase. I don't know, the story got out there, but in 1 week, that's what happened. And this will happen maybe 0.1% of the time. So
Yeah, sure. And it's always a price anchoring is also always a problem, especially when imagine that you find an interesting idea. Somebody wrote about it a year ago, and in that year it already doubled or tripled. Then it's always a bit more. It's always a hurdle to get over that price anchoring. But yeah, only the future counts. So you need to disregard that write up and what it did in that year, and look at what the future potential still brings, and maybe at the new price, there is still a lot of room for return, and there is a lot less risk maybe a year later in the company. So
yeah,
sometimes when time goes by, maybe you lose a bit on the return, but you gain in the sustainability or the probability of getting that return. um, because
yeah, I
maybe a
love that.
year ago, when the person did his initial write-up, there was a lot more risk in the company and everything went right. So that's great. But the possible outcomes at that time are a lot wider. than a year later. So
Hmm.
it could be a better
Yeah.
investment at a higher price.
Yeah, for sure. I think that's correct. And um, I wanted to ask you because Valley Bridge is all about being practical, and we've been talking about all the like concepts that make up 100 baggers and your personal approach and all that. But I would love if you could give us like a practical case study of I'm not sure if you ever had a 100 bagger, but yes, a case that illustrates really well what your strategy is, and maybe obviously if you as you have like a flexible strategy both for micro and larger caps, you can give two case studies or whatever feels comfortable. So yeah, just
Yeah,
let me
sure.
know and then I can ask some questions.
I'll throw in a loser also with that because
Yeah,
I
nice.
think I'm pretty active on X, and I write a lot. And you see a lot of people claiming they're winners or their portfolio returns. But I think it's very important to publicly acknowledge the losers you had, because
Yeah.
that's the only way you can go forward and learn and get better every time. Um, yeah, so maybe well, let's start with the loser first. When I think it was like 2 years ago, I came upon a small gaming company in the UK. It's called Tiny Build, and
Okay.
I made it. The biggest mistake I made was not picking the bad company. That was not a mistake. The biggest mistake I made was sizing it too high, because based on my analysis, I I thought I had an edge. You have to understand that this company had a decreasing price, and the business was in a very difficult climate and deteriorating. But at the time, I thought it could be able to turn everything around. But the problem was the gaming market was in a lot worse state at that time than I initially uh, thought. In addition, there were some gaming projects that failed, and what happens then is they have to do a lot of write-ups. And basically, what I learned from investing in that gaming company is a gaming company is extremely hard, because everything in life, I think a lot of things in life and especially in investing, is dominated by power laws. So you have these outliers, and it's the outlier that determines everything, or most of the things. So for example, in my portfolio, my return is determined by one or two outliers. The others are doing okay. Maybe there's one or two losers in there, but it's the outliers or the big winners that drive the entire performance. It's the same thing
Hmm.
in the S&P 500. The S&P 500 is driven by the Max 7 or maybe the top 10, but they drive the overall performance of the index. And so for a gaming company, it's the same thing. When you have a game publisher, it needs a big hit. If it's always a company and it does okay, it will never give you great returns, especially because they have to invest the cash upfront. So it's a very working capital intensive, and yeah, and so as long as the company doesn't get this big winner, you won't hear about it. In Poland, you have a CD project who made The Witcher. They had their big winner with The Witcher, and then they started generating great returns. So this tiny company, Tiny Build in the UK, didn't have that, and so it was a bad investment. Now I have to say that over the last 6 months, it doubled again, because it seems they were on track to get that first big winner. As I said before, I didn't sell out completely. I trimmed, so I still have a small position. So that's a good position that is up on the year. But that's a first practical example of a loser I had, where I lost some money. Now, to show you why it's important to take losses, because it's difficult when you go into a position like that and you have a big position, and you know that if you sell, you're going to realize the loss. You always have to think about it, a bit like Jeff Bezos said about Amazon: every day is day one. It's the same thing in
Hmm.
investing. Every day is a new day, and you have to, like, it's very difficult, but forget about everything in the past and start anew. And so basically most of the cash that I still had after selling, I invested it in Pharmex Technologies, and that became a triple in a year. So basically, I already regained most of my losses and a lot more based on taking that loss. So I think it's especially true when hunting for underbaggers, but I think in general you have to get accustomed to take a loss. You don't have to. It's not a bad thing if your sizing is correct. You will regain everything with thanks to the power law and by having big winners. And so that's one practical case on a loser.
Hmm.
Um, and then yeah, to show my yin yang, so the dual investing strategy. So I already mentioned Adyen at the start, which I think is a very high quality company. Um, Basically, in those circumstances, I already analyzed Adyen before, but I thought it was too expensive, and then you have to wait. Now, at a certain point in time, the price drops because there is some lower guidance into the future. And because these companies trade at higher multiples, the price drop can be very significant. So I think it was 40%. Um, and then I bought, and then I think 3 months later, it was a double. Now, afterwards, you can say with hindsight bias, oh, look, it was easy. You did the work before, you were prepared, the price drops, you buy, and then it doubles again. I can tell you it wasn't easy at all because even though I did the work, when you have a stock like that that drops 40%, you have a lot of negative news um, everywhere to say why Adyen is no longer performing and why it's a bad company. And for me, um, I find it a lot harder to go against that and to be
Mm.
contrarian than to just buy a small company where it's pretty clear that they're going to double their EBIT in the next 3 years, and you have a high probability of doubling your money. So I even believe that the case that I mentioned for Adyen is probably the hardest case for me. I find it difficult to be very contrarian towards the market, against the market. Yeah.
Yeah, that's extremely interesting. From the first case, the lesson I take and that resonates with me the most is basically sometimes you just want to break even, right? You get a big
Yeah.
loss and you hold until break even and then get out. And maybe that's actually the wrong time to get out because if the stock is recovering, maybe something changed and you didn't factor that into the decision. But yeah, most of the times, like if you're actually wrong, if you actually made a mistake, you're better off just selling or trimming and putting that capital to work into a better decision or better opportunity or something that looks compelling. And that's the perfect kind of practical example. And that's why I love practical examples because you can kind of reconcile the theory and everything that you have studied about investing and actually like kind of make sense in your mind and visualize it. And with Adyen, I this is the second time you mentioned Adyen, and I'm kind of I have a big regret because at that time I was actually looking at payment companies, and I decided to invest in PayPal
Oh,
instead of Adyen. and so
yeah.
and so like everyone was talking about Adyen, how Adyen like was dropped a lot, and like the payment companies the sentiment in general was out of favor from what I
Mhm,
recall.
mhm.
And my thesis with PayPal was I actually have a video, so you can go check it out, and the thesis is in the video. Um, the thesis was like the sentiment will change and like the like they will recover, like um they will do better in the future and so on. And for some reason I didn't get myself to look at Adyen, and as you mentioned, like 1 week later, or like when I started looking at it, no, maybe 1 week, no, but a couple of months, let's say a couple of months, I saw people posting, "Oh, Adyen 100% return in 3 months or whatever," and I was like, "Oh my god, I missed so much that opportunity." And it's
Yeah,
it's
but
funny because I was actually looking at the industry at that time.
yeah, but just to make clear, when I entered Adyen, I never believed I would double in 3 months. I mean,
Hmm.
I was just thinking this is a good price for a high quality company. Let's see what happens in the next years. That it went up again 3 months later. I mean, somebody who says, "Hey, I made a double in 3 months. Look at how genius I am." I mean, I'm very skeptical. You couldn't have known that in advance. Um,
Yeah, no, for sure, for sure. And actually, I think this guy was very humble. Like
yeah, sure.
he said, like something. I mean, it wasn't just a guy, but yeah.
Yeah, and I think what helped me in the past with like taking losses is you know the big disclaimer when they say if you lose 50%, well, you have to make 100% to get your money back.
Hmm.
Uh,
Yeah.
but uh, once you once you've invested and you've seen stocks go up double or more in a year, it becomes easier because even if you take
For sure.
50% loss, you know it's possible to recover. It will
Exactly.
take some time, and I think when I started my investing journey, a 50% loss was like a massive. I mean, wow, uh, how could I ever recover from that? But yeah, with experience, you see what happens, and there are even stocks that go up 10 times in 2 years. I mean, the stock market is an incredible place. So yeah,
Yeah. And sometimes even your doubles then will go down, and then it's like a roller coaster, right? Just within this year, I think, yeah, I had two names that were a double at some point, within less than a year, much less than a year, like maybe 6 months or so, were a double at some point, and then came back down, and then came back up, and then back down. So you just have to get used to it. And I think, from what I understand from your experience, is like, don't like make a big deal out of these things, because at the end of the day, you want to focus on the process, right? I think that's what I'm getting from this conversation.
yeah, you have to focus on everything you can control. You can't control the price in the market, but you can control your own process, and that's what you have to be focused on. Yeah,
Mhm. Yeah, and by the way, I also had big losers, so I'm not saying I'm a genius.
yeah,
Uh, just a disclaimer, because so yeah, we all have a bias towards, like, oh, look at how smart I am. I had like all these multi-baggers or whatever. Um, nice. So I just want to switch gears again and maybe talk a bit more about the newsletter business, and like that as a business, because not because I want to go into the newsletter business, but I think it might be helpful for other people that plan to go, or like try to launch a newsletter. I think you do a very good job at it, and so, and also from the standpoint of learning a business model, because the newsletter business can be a pretty interesting business model. So
Mhm.
um, yeah, you can just give me general thoughts about how it started, how it's going, and what are your plans for the future, and in terms of like economics, whether it makes sense or not, and then I can ask some follow-ups, if it
Sure.
makes sense.
So um, I've started investing 15 years ago, and then almost 2 years ago, I started writing online. My
Hmm.
goal was not to start a business.
Hmm.
My goal was just to share my passion with other people. Um, and I set out to write one article each week, so every Friday. Um, and I did that until the end of the year. And then at the end of the year, I don't know. I try always to set certain goals at the end of the year. Can be a health goal. It can be something else. And so at that time, I said, well, let's just continue and try to get out one article every week for the 2024 for the entire year.
Yep.
And I just kept doing it. And then the number of subscribers increased, and more people came in, and I got questions. I got invited to other podcasts like this and to some speaking events. And so at the start of this year, in February, I said, "Well, okay, let's get more serious. Let's turn this into a paid newsletter and see what happens."
Hmm.
Um, and so for the moment, it has grown pretty well. I think the newsletter business, especially in investing, it's very competitive because you have to, yeah. you have to take into account that there's a lot of Substacks, a lot of newsletters out there, and I get this often from people who say, "Look, I'm interested in your newsletter, and I'm interested in a subscription, but I already have 2 or 3 subscriptions. So this year, I don't want to go beyond that because if I have to pay $300 or $400 per subscription, it's getting a bit sizable in the amount that I can digest also, but also in the amount of investment I need to make. So I think the newsletter business is very interesting in the sense that if you look at outside, if you're an analyst, these are high gross margin businesses with, if they grow, a lot of cash flow that comes in. So from a business model perspective, they are very interesting. But there is a lot of work involved, and there is a very high number of competitors. Now, I don't really see other newsletter creators as competitors because we learn from each other and I talk to everybody. But from a business perspective point, it is there. This is not uh, yeah, it's a hard business. Um, you have to take into account not only the writing, but you have to think about marketing. You have to put yourself out there. If you, there are only very few people who can run a newsletter profitably without a lot of marketing. Um, one of my favorite newsletters is, for example, Dirt Cheap Stocks. Um, and why is this newsletter so successful? Because I think at the end of last year, he wrote an article that is called Accidental Entrepreneur, where he
Mm.
talks about how he stumbled into all of this. But yeah, I mean, if you look at his writing is like the one of the best writing out there, and he he doesn't post very often. Even on X, he doesn't post very often. But he is known as the guy who knows everything in the US microcap space. Um, and yeah, he has built up a certain reputation based on the quality of what he puts out. But that's rare. You need like a significant amount of skill to get there before getting to that kind of level. Um,
Yeah, man, I think he's such an interesting case. I never talked to him, but I know people that know him. And first of all, he's anonymous. Maybe for the people that
Mhm.
aren't familiar with him, just giving some background. He's anonymous, and like you mentioned, he doesn't write even that often. Doesn't post on X that often, but he's really really good like at investing, and he has posted. I think I'm not sure like if I'm saying something wrong, but I think it was close to 50% returns or something. Maybe over the last
yeah, it
couple
could
of years.
be.
You can go fact check that. I'm not sure. I think he stopped sharing performance last year, starting from this year, but as of last year, his IRR was like 50% or something. So he was doubling. Yeah, very very often.
Yeah, I think if somebody is hesitating to start maybe a newsletter themselves in the finance space, I would say try to like build a skill um, at a very high level because that will help you a lot. And the second thing is make it a bit more unique um, because I think there, for example, if you are the next newsletter who's going to talk about the semiconductor space, I think there's a lot of newsletters already around that. With AI, there are a lot of newsletters that just talk about AI. So the space is pretty saturated. So you need to like find a novel approach in building a newsletter, and then I think the second important thing is to battle against AI is to make it personal. So try to infuse experiences from your personal life in your writing. Show that each article is written by a real human, because I think people also connect with the author. So it's not only about the company analysis or, for example, the 100 bagger data study I'm doing. sometimes people just want to read what I'm writing because
Hmm.
I'm the author. Um, and I think that's important. Don't try to make it generic. For example, I use AI in my stock analysis, but I don't use AI to write my articles. So
Hmm. Yeah, I think that's a very interesting point because it's very easy to sense, not just from the style of the writing, but also from the actual, I don't know, just feeling you get when reading an AI article
y-
versus like
you
a
see
real
it.
person.
For me, the biggest indicator is the words that are used. Usually, an AI will exaggerate a little bit. They use words that you don't use in your normal language when you talk to someone, and
Hmm.
that's for me, it's the quickest method to see if it's written by AI or not. And
Yeah.
maybe, I mean, for example, at the moment, I'm only posting one article every Friday, and it's a bit longer than maybe the usual articles. Um, I see people posting 2, 3 times a week, but I also see the AI in there. And I think if the market is being flooded by investing analysis created by AI, people will eventually see that and they will flock to those that are not using it in that way. So
Hmm. I'm kind of guilty of using AI in the sense of like correcting the text or like making it slightly
yeah,
more
sure.
cohesive
Yeah, but
because
that's not the same
yeah.
thing. And then you don't have to feel guilt about that. That's just if you have a draft text and you ask the AI, can you make this better based on this and this criteria? And then you pick what it gives you. Because I see the same thing when I write about using AI tools to do stock analysis. Some people are very against it. They say the only edge you get is if everybody starts using AI, then going deep into an annual report and reading everything you can on a company, that's the real edge. And in some ways, I agree with that, but you don't have to exaggerate AI in the sense that when Google search was introduced, at a certain moment, people started to use Google search and they started to use it to do their analysis. AI is just a tool, and it all depends on how you use it in your analysis. AI on itself is not bad or is not good. It depends on how you use it. So
Yeah, I certainly agree, and I still write everything myself. I'm I'm just like so I agree with your point. Like you should use it as a fine tuning tool, like in the writing and as an assistant in the investment process, but not as the decision maker or the sole like creative mind behind like the writings. And so I'm not sure if you want to share this or not, but how many subscribers you have right now, and how many paid? Like, what's the conversion there? Because obviously you're taking this seriously. For example, in my case, I don't plan I have two newsletters. So the Value Hunt is like where I post my independent research on microcaps or things I'm looking at, and post like my reviews. And I never plan to take that like paid, or at least for the foreseeable future. I guess you never plan for these things, but and then there is Valley Bridge associated with the podcast, where I just publish like the podcast and everything the CEO has ever said, like the compilations and all that. So yeah, just curious to know what sort of conversion you get there, and like yeah, maybe some hard data.
yeah, sure. So for the moment, I'm closing in on 11,000 subscribers for my newsletter, and I have about 200 paid subscribers. So that's like a 2%, 2%. But I try not to think too much in conversion rates. I mean, every day that goes by, I'm thinking about stocks, and I'm also thinking about how can I make the newsletter a little bit better than yesterday. And so,
Hmm.
how can I bring more value to each reader? And then I think at a certain point, if I can keep on bringing more and more value, then people will come in. I mean, because you can do like an entire marketing analysis on, okay, I have a 2% conversion rate. How can I increase this to 2.5? What are the tactics I need to employ? But tactics only work if the base quality and the base value you give is there. And I think there are people who forget that they are focused on the tactics and not enough focused on the quality and the value they deliver. And that
Mhm.
should be the main driver. Yeah.
Yeah, I think it's interesting the way you put it. It's like in soccer or football, for us European, that where you have like great tactics, but the players aren't that good, so you can't like really do anything with it. But you also, at the same time, you can't have like the best players and the wrong tactic, because if you don't get your stuff out there, or if you don't
Yeah.
at
Yeah.
least take it in consideration, you fall into the risk of,
I mean,
yeah, I'm doing
we,
great work and not putting it out there.
yeah, we took the example of dirt cheap stocks. For me,
Yeah.
dirt cheap stocks is an anomaly. So you need to, if you're good at what you do, you need to put yourself out there. You have to pick a social media platform. I use X mainly, but you can use whatever you want. And yeah, you need to post, you need to market what you're doing. Trying to bring value in the posts you deliver, because thinking that you're going to write the best company analysis ever written by mankind, even if you do that, people won't find you. They If you think they're going to use a Google search to find you, or maybe now it's Perplexity or whatever, um, it's not going to happen. You have to put yourself out there. And I think most of my subscribers, or even the ones that decided to go paid, um, they are from like speaking events, live events, podcasts. Um, it's You have to show yourself who you are, talk about your passion, and try to deliver value, because it's very hard. Imagine if you never appear somewhere, or you don't do any speaking events, or you do nothing. The only thing you do is writing your newsletter. It will be very hard. um,
Yeah.
only very few people will be the next dirt cheap stocks.
Yeah, he's the goat, man. He's
Yeah,
like,
yeah,
I when I have the budget to subscribe, I'll probably do it.
yeah.
For now, I'm reading the I'm reading the free articles, but they're so good, and you can take some really interesting lessons from there. And he's a great influence. If you go to my Value Hand Substack, I plug his Substack in and say like, yeah, he's a big influence for me. So yeah, that's interesting. It's a topic I'm not used to talking about. It's not something I'm very knowledgeable about. So I'm glad you came in and gave me some of the hard on insights. Um, yeah, last question I have for you is actually, what questions should I be asking you that I haven't asked already? And I think that's a great way to wrap up as well. So yeah, just let me know. Yeah, yeah, yeah. I think we don't have to go through the ceremony of yeah. Hmm.
Isn't it crazy that 80% of you aren't subscribed? So if you made it this far, here's my promise. Follow or subscribe for free, and my team and I will make every episode 1% better. Check out the last episode too if you enjoyed this one, and thank you so much for listening.